Hello, good day. In this lecture, we will continue with more technical analysis. More specifically, we will look at chart patterns. So the outline for the lecture today would include Fibonacci retracements, and we will look at chart patterns. So the first thing we want to discuss is Fibonacci retracements. What are Fibonacci retracements? This sounds very technical, right? Well, it is technical, but you can understand it. Fibonacci retracements are ratios. These ratios arise from the number sequence 0, 1, 1, 2, 3, 5, 8, 13, and so forth. So you might ask yourself, how do we get this number sequence? So we start first with a 0, then we add 1 to the 0. So 0, then add 1 to the 0. So the first number is 0, the second number is 1. How do we get the third number? We take the first two numbers and add them together. So 0 plus 1 will equal to 1. So this is how we get the third number. How do we get the fourth number? 1 plus 1 is equal to 2. This will give us this number. How do we get the fifth number? 2 plus 1 will equal to 3. How do we get the next number? 3 plus 2 is equal to 5. Then to move on, 5 plus 3 will equal 8. Then how do we move on? 8 plus 5 will give us what? 13. How do we move on? 13 plus 8, what number you will get? That's the number right there. So you can keep going on and on and on. Now, how do we get the ratios? We take the ratios here and we divide the number by the previous number. We take number 34 and divide it by 55. So this is the ratio between this number and this number. So 34 divided by 55 is equal to 0.618. Now, if we take the ratio between the next set of numbers, so if we take the ratio from 34 to 89, you will get 0.382. How about if we take another number? How about if we take the ratio between 55 and 89? What will you get? These numbers, these decimal numbers will be the Fibonacci ratios. So you just experience or you just observe the Fibonacci sequence. A Fibonacci sequence is formed by taking two numbers, any two numbers, adding them together to form a third number. We saw that previously. We take two numbers, we take the 2, we add the 1, and we derive a third number, number 3. We take the 3, we add the 2, and we derive another number. That number is the 5. So we take two numbers, any two numbers, we add them together and we form a third number. Then the second and third numbers are added again to form the fourth number. And this process continues on and on and on. The ratio of the last number over the second to last number is always approximately equal to 1.618. This gives us a number which is referred to as the golden ratio. This is actually an irrational number like the number pi. This golden ratio is denoted by the Greek letter phi. So this might sound very technical. In reality, you do not have to calculate the Fibonacci ratios. There are software that can do this for you. Traders use Fibonacci retracements as levels of potential support and as levels of potential resistance. In other words, we look at the swing highs, we look at the swing lows, and using this information, when we do a connection from the swing high to a swing low, we can determine where a potential retracement could be. So we see here on the chart here, a swing low and a swing high. Then how do we compute the Fibonacci retracement? We take the arrow, we connect the swing low to the swing high, we do the connection, and we can see the Fibonacci numbers. So I will show you here on a diagram how to draw a Fibonacci. So I just choose a random asset. The asset I choose is the JPY euro. So I will choose my Fibonacci tool. I connect from the swing low and I go to the swing high. So this is the Fibonacci ratio. Observe, I did not have to manually compute any of the retracements. In fact, the software did all the calculations for me. So according to the Fibonacci, a retracement should be somewhere around here. And we can actually see it. This was a retracement. This occurred at the 23rd percent, 0.236. It suggests that the next retracement should occur at the 33%. So that's 0.33. We saw here that there was a retracement here at this point here. Then the next retracement should occur at the 50%. That's the 0.5. There was some retracement here. This was some level of support for some assets. Now, you may be asking, how can we determine if this was some level of support? Recall that we looked in previous videos that higher highs and higher lows, high points and low points can be used to determine support and resistance. I know this was a level of resistance here because this was some peak. This was a point the price of the assets went up, it reached a maximum point and then went down. It touched the point twice. So we can say it touched the point about 3 times, 1, 2, and if it is, we say the resistance is a range. Let me just draw a range to clarify. So if resistance was a range, resistance could be anywhere in this range right here. Resistance could have been in this range, and we see the price of the asset touch 1, 2, 3. 2 touch suggests a possible area of support or a possible area of resistance. 3 touches actually confirm that a certain area is actually support or resistance. We see here 3 touches. So this suggests this could be some area of resistance. So if this is some level of resistance, let's move in this for clarity. This would be the swing high. This could be some possible area of support. It touched here 1. This was some level of resistance. So it touched here 1, 2. So this is some level of structure right here. If it is, we say resistance is a range. The range could go from here to here. Well, this area here, this range here would be some area from this area from here to here would be some area of resistance that would have served as support. Right now it's serving as support. After the price of the asset broke resistance, this resistance served as support. Then it broke support again. And then this area became some resistance. So let me just draw a line here to show. So you can see here, if this was some level of structure, the line broke resistance, it touched 1, it broke resistance, it came down, the resistance acted as support, it went back up, the resistance acted now as support, so this is now support, it break support, it go back here and touch and come back down, so now support is acting as resistance, so this is some level of structure right here. And how do we confirm that? The Fibonacci ratio suggests that this is some level of structure right here. The next Fibonacci ratio suggests that this area could be some level of resistance or support. Let's put it exactly on the line. Well, it touched here. This was just short, but you can see that resistance or support was a range. The next level of structure is right here. So let's draw the line at the 50%. The next level of support is right here. And the last level should be somewhere here. So there you have it. We can see that anyway, what the Fibonacci ratio or what the Fibonacci retracement tool is telling us possible areas for the price to change direction. So if these are actual potential areas where the price might change, then, and we're going forward, if these are potential areas where the price might change, then when the price reach here, it could either bounce off. So if the price was going down, it could either bounce off and go back up. If the price was going up, it could either bounce off and go back down. So we see here, the price went down, it bounced off and went back up. Now we see here, the price actually broke the area of support, it went down. It broke the area of support, it went down. It broke and it bounced off right here. So this acted here, this point here acted at some level of resistance and went back down. It bounced off. So this is acting at some level of support. It bounced off support and went back up. Broke support. It fluctuated around the level that was acting at some level of support, went down. This is the Fibonacci retracement. This tool is very easy to use. So I'm moving on. So we are looking at chart patterns. When we look at chart patterns, we are performing technical analysis. However, this part of technical analysis is called price action analysis. In other words, price action analysis is a subset of technical analysis. Chart patterns are useful and they are very important. They can tell us potential entry points in trends. So they can tell us potential areas to buy or potential areas to sell in trends. They can tell us potential areas to set a target profit, and they can tell us potential areas to set a loss. So we will look at several chart patterns. The main chart patterns that we'll cover in this lecture include the double top and the double bottom, the head and shoulders and the inverse head and shoulders, the rising and the falling wedges, so rising wedges and falling wedges, bullish rectangles and bearish rectangles, bullish pennants and bearish pennants, and triangles. Note that triangles are very similar to wedges. So the first pattern we will look at is called the double top. Can you guess why this pattern is called a double top? Well, we can see a double top. The price of the asset goes up, it goes down, it goes up, it goes down. So there's one peak, it goes down, it goes up, it goes down. This area here is called the neckline. So the area of the price close, and then there's now a change in the price of the asset to go back up. This area here would be the neckline. This is also a double top. So the price of the asset goes up, it goes down, it goes up, it goes down. So we expect the price of the asset now to go down even further. So this was a trend. The price of the asset was trending up and made a double top, and then we expect the price of the asset now to go down. So what would we do? If we was to place an order, we would place an order to sell somewhere right about here. We will place a stop loss somewhere around here, and we'll place an order to sell, or we will place an order to go short. Going short means to sell. We will place an order to go short somewhere around here. And we can ride the price movement all the way down. The double bottom is the opposite chart pattern to the double top. It is the inverse of the double top. So the price of the asset goes down, it goes up, it goes down, it goes up. We see a neckline form here. So the price of the asset went up, it closed, and then there was a change in the trend, it went back down. So this gives rise to the chart pattern here. This area here was the neckline. When the price of the asset goes back up and reaches the neckline, we expect the price of the asset to go all the way up. So you see here, the price of the asset goes all the way up. So if we was implementing an order, we would have gone long. Going long means to buy. We'd have gone long right here. We would have set a stop loss somewhere around here. And we would have ride the trade all the way up. This chart pattern is called a head and shoulders chart pattern. So the price went up, it went down. When it went down here, it formed a neckline. It went up, it went down. It went up, it went down. So there are 3 peaks. 1, 2, 3. However, the middle peak is the biggest peak. So it went up, went down, went up, went down. So when it went up here, this area here formed a head. This area here, this peak was higher than this previous peak. And then it gives rise to a third peak, up, down. And this peak here is almost equivalent to this peak here. So this gives rise to a head and shoulder chart pattern. So we see here, these are the 2 shoulders and these are the head. So when we see a head and shoulder chart pattern forms, the next direction for the price to go is down. So we can enter a trade here to go short, and we can ride the movement all the way down. If the trade moves against us, we'll set a stop loss. The stop loss could be somewhere around here. And this would be a very good trade. This would be a win. We also have the inverse head and shoulders pattern. So we see here with the inverse head and shoulders, the price of the asset went down, it went up. It gave rise to a neckline. It went down, it went up, it went down, it went up. This is a mirror of the head and shoulders chart pattern. It is the inverse. It looks almost identical to the head and shoulders pattern, but upside down. So it went down, it went up, it went down, it went up, it went down, it went up. But the second drop, or the middle drop, is the biggest drop. So we see 2 shoulders, well, 2 inverse shoulders and 1 inverse head. The inverse head is deeper than the inverse shoulders. If we was trading this chart pattern, we would have placed an order to go long at this point here and ride this all the way up. The next chart pattern is called a wedge. A wedge chart pattern is formed when 2 trend lines converge. This means that the trend lines, when we draw the trend lines, they attempt to be moving together. Rather than drawing trend lines that are parallel, the trend lines tend to be converging or moving towards each other. To some point, if they continue, at some point they may meet. Wedges give a signal that there may be a pause in the current trend. So there are different types of wedges. There are rising wedges and falling wedges. So this is a rising wedge. So a rising wedge forms in an uptrend. We can see a series of higher highs. We can see resistance, resistance, resistance. We draw a trend line here, and we see resistance forming. We can see some level of support. So the price of the asset goes down and forms support, but we can see higher lows. So we see the trend line sloping here, and this is a steeper slope. So this resembles a triangle. That's how I recognize wedges. Wedges resembles triangles, and a rising wedge is upward sloping. Now, a rising wedge suggests that the price of the asset may change because all the price of the asset is going up. The mere fact that it is making higher highs, yes, but the higher highs, the gradient of the higher highs formed by the trend line here is not as steep as the gradient by the higher lows here. It suggests that the price of the asset is losing steam, it is losing strength, it is losing power, and the price of the asset may go down afterwards. If this is true and the price of the asset goes down afterwards, then the correct area to place a trade would be somewhere around here. We would go short and ride the movement all the way down. So the inverse of the rising wedge is the falling wedge. This forms in a downtrend. The price of the asset is going down. We can see a series of lows and see a series of lower highs. So it's a high point. This is a high point. This high point was lower than this high point. This high point was lower than this high point, but they are lower highs. The gradient here is steeper than the gradient here. This gives rise to a falling wedge chart pattern. This suggests that the downtrend is coming to an end and the price of the asset might change and go in an uptrend. We see here, the price of the asset broke the level of resistance. This was the level of resistance. It broke resistance. So we could have entered a trade right here to go long. Going long is to buy. We could have go long, we could have buy the asset and go all the way up. As a precaution, we could have implement a stop loss just below this point here, somewhere around here. So if the trade moves against us, it would have hit the stop loss. And if we take a loss, it would have been a small loss. However, if we take a win, it would have been a very big win. Could I ride it all the way up? The next chart pattern that forms is a rectangle. A rectangle forms when the market is going sideways. Market is going sideways. So you see here a resistance, highs, highs, highs. We see resistance, and the resistance is almost parallel to the level of support. Support, this trend line here signifies support. The resistance is more or less parallel to support, and the asset is going sideways. How do we trade this chart pattern? Well, we could buy at the level of support. We could sell at the level of resistance. I mean, we could do this, but the day that there's a breakout of the resistance or the day there's a breakout of support, that trade will end up turning into a loss. So we can set the stop loss here. If it is buying somewhere at support, we can set the stop loss somewhere below here. If it is we selling somewhere at resistance, we can set the stop loss somewhere here. The stop loss is a tool that is used to minimize risk. Risk will be explained in greater detail in a future lecture in this video series. So we see here a rectangle. Now, this is not just a rectangle. This is also a flag. This was a pole, a short movement down, and then we see a rectangle form. So a flag is a combination pattern. We have a strong movement down and then a rectangle form. This gives rise to a flag chart pattern. This was a BF flag. You can also have a bull flag. Well, this wasn't really a good bull flag because the price of the asset was in an uptrend first, then it went sideways. So this chart pattern is just a rectangle, but this chart pattern here, this chart pattern is definitely a BF flag. So since I was speaking about flags, I will skip this slide and go to the next slide and speak about flags first, and then I'll go back to pendants. So a flag is a combination pattern. It is a combination of a strong price movement and a sideways movement, or it is a combination of a strong price movement and a rectangle. So we saw previously the BF flag. This was the BF flag, a strong movement down, then a sideways pattern. This was a BF flag. Then we could also have a bull flag where we have a strong movement up. The price of the asset goes sideways. So when the price of the asset goes up and then goes sideways, this is a bull flag. The next combination chart pattern is a pendant. We can have bullish pendants and bearish pendants. In the bullish pendants, there's a strong movement up. The strong movement up is called the flagpole, and then a triangle form or a wedge form. This case here, it looks like a triangle. So this gives rise to a bullish pendant. In a bearish pendant, there's a strong movement down. The strong movement down is called the flagpole, and then a triangle pattern forms or a wedge pattern forms. In this case, this looks like a triangle pattern was formed. So I just spoke about triangles. Triangles patterns are very similar to wedges. This is what a triangle pattern looks like. This is a symmetric pattern. We can see it forms like an isosceles type triangle. Lower highs, higher lows. This looks symmetric. When I say it looks symmetric, it mightn't be perfectly symmetric. This is just a general idea about how it looks. This is a triangle chart pattern. This is also a triangle chart pattern. We see some level of resistance. We see higher highs, upward sloping support, and this gives rise to an ascending triangle. We also have here a descending triangle. We see some level of support that was horizontal. Then we see a downward sloping trend line, which gave rise to resistance. Resistance was downward sloping and was steep. And this gave rise to a chart pattern called a descending triangle. When we combine the triangle patterns with a pole, we can form pennants. We can have a bullish pennant or a bearish pennant. So this brings us to the end of the lecture today. In the next video, we will explore more chart patterns. Thank you.